This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
MacroVoices episode 334 was recorded on July 28, 2022. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. By popular listener request, Adam Rozencwajg of Gehring & Rozencwajg joins me as this week's feature interview guest. Adam shares my view that the world has entered the early stages of a global energy crisis that will take many years to resolve, and he brings some absolutely fascinating insights about U.S. natural gas prices, which Adam says are about to converge with much higher European natty prices as U.S. export capacity expands and shale gas production declines. We'll also discuss gold and the developing fertilizer crisis. Then be sure to stay tuned for our post-game segment after the feature interview, when Patrick's chart deck will be titled Post-FOMC Market Moves.
Yeah, well, the post-FOMC market move we're going to talk about right now is that S&P 500 rally that's been going on in the last 24 hours. And we've seen us, move off the lows just close to 3,900. And we're decisively now above 4,000 on this S&P. What do you make of this bull breakout? Do you think it's got some legs near?
Well, all of the chatter that I see on Twitter and commentary in the press is, well, this 75 basis point hike, which is, by the way, part of a series of 75 basis point hikes, was apparently a dovish 75 basis point hike. It's kind of like Nancy Pelosi is a conservative San Francisco liberal Democrat, which by San Francisco standards she actually is. I think what's going on here, Patrick, is there is so much widespread expectation of, okay, when is the Fed pivot moment happening where the Fed pivots to a completely dovish policy? And for whatever reason, it seems like despite the fact that this was a 75 basis point hike, the comments that Jay Powell made it seem like he's kind of on the dovish side of 75 point hikes, just like Nancy. I think the Fed's basically been pretty clear that it's going to be data dependent. And so to my thinking, most of the market is basically thinking, okay, look, inflation has clearly, it must have peaked by now. We thought it peaked in Q1. In fact, all the same so-called experts that were certain it peaked in Q1 are now certain that it just peaked now. One of the most important lessons, though, despite the fact that it's hard for me to believe any of this, because to my thinking, there's no reason to assume inflation has peaked until it's really peaked. And I don't think there's any reason to assume that the Fed is about to dovishly pivot until inflation really does peak. But that's not the market perception. And if there's anything I've learned about trading, it's you don't fight Mother Nature and you don't fight, the trend is your friend. Don't fight the tape. Regardless of whether it makes sense to me personally or not, what's going on here is a really spirited rally. Is it just the mother of all short squeezes and we're about to get a blow off top before the really big drop, maybe later in the summer, and we get down to new lows in the fall? I don't know. That's possible. But right now, the trend is up. I wouldn't want to be fighting it, so I'm certainly not rushing in to short this market.
All right, well, let's move on to the dollar index, which kind of had some intraday volatility, but never really left its 1 week range. I mean, we're trading at 106.5 here on Dixie, and we're really seeing a mixed bag with a lot of the different currency cross pairs. And so really lack of any conviction. I thought there would be a little bit more gusto on a move in the post-FOMC, but really nothing. What's your take on the dollar here?
Well, it's finding support around 106. It's traded sideways through a very short-term trend line that began in mid-May with that low. And okay, I guess if you really want to try to make a bearish argument, you could say we did go through that trend line. It didn't move higher when it hit the trend line, but hang on, it didn't dump lower either. It's just a sideways consolidation. So to my eye, we're looking at a healthy consolidation in the context of a bull market. We're taking a pause here. I don't see any reason to think the dollar's about to dump.
All right, Eric, we got to get to the crude oil markets. And really, I'm actually quite shocked that almost for an entire month, we've just bounced around like a ping pong back and forth, not really wanting to commit anything down into below 90 and really not wanting to break out 100. And so like a ping pong back and forth, it's getting dizzy here. What's the next move for crude here?
Patrick, it's been a huge week. I've got so much to say about this. I'm going to save a lot of it for the post-game segment because this week's feature interview with Adam Rozencwajg is all about energy and natural gas and crude oil and so forth. I don't want to steal Adam's thunder, so I'm going to cover EIA inventory, give you a quick outline of what we'll talk about in post-game, same as I did last week, and finish up with just a couple of thoughts on the short-term market, and then we'll cover the really substantive content on crude oil in the post-game segment when we get to the crude oil chart. EIA inventory came in this week with a drawdown on crude oil of 4.5 million barrels. That's a pretty big draw by itself, but really the real number was 10.1 million barrels if you include the 5.6 million barrels that was recklessly drawn out of the Strategic Petroleum Reserve. The SPR dropped to its lowest level since June of 1985. Cushing, Oklahoma, building 751,000 barrels, but we saw drawdowns on the finished products this week. Gasoline drawing down 3.3 million barrels. Distillates drawing down a much smaller 22,000 barrels. U.S. production did tick back up, a couple of ticks, 200,000 barrels up, back to 12.1, which has been the recent term high. Of course, it was 13.2 or 3 before the pandemic crisis, but post-pandemic, we're back to the high, and I think it's set to move higher. OPEC Plus is set to have a meeting on August 3rd. That's next Monday. Now, Reuters spoke to 8 different OPEC Plus sources. Only 2 of them said that a modest increase in production for September is going to be discussed in that meeting. Meanwhile, 5 of them said that output was likely to be held steady right where it is. Now, Patrick, I noticed some really interesting tape action Sunday night into Monday. We sold off in illiquid Sunday night session, went down and retested that continuation 200-day moving average. But then as soon as Europe opened, there was, and that would be Monday morning Europe time, late night or overnight in the United States. It was straight up from the European Open, and then there was follow-through during the American session, more straight up, and even post-close, more straight up after that. We got to the point where on Monday evening, we broke trendline resistance to the upside. That's a trend line that's been in place since this sell-off began in early June. It only broke it by $1 or so, but it was looking pretty good. It seemed to me like we were on the edge of an incipient upside breakout. Now, it seems I was not the only person to notice that on Monday night because first thing Tuesday morning, the Biden administration announced its intention to release another 20 million barrels out of the Strategic Petroleum Reserve right into election season. Surprise, surprise. And, of course, that caused the market to drop like a rock because of more oil coming into the market. Now, to put this in context, Patrick, we began 2022 at 80% of SPR capacity. I would argue that as soon as February 24th happened, we should have been replenishing to 100% to restore that strategic reserve in case we need it in the event of war. It turns out that by the time we're done now with this additional 20 million barrels that was just announced, we will have drawn down to only 53% of SPR capacity when the already announced SPR releases complete just around election season. I fully expect them to get even more desperate and probably release even more after that. I don't think it's going to do anything to help prices long-term, Patrick, because there have been plenty of SPR releases in the past. They've never worked to solve a price problem. But get this. After crashing the market on Tuesday morning with this big dramatic release from the White House, the market fully retraced that move in 26 hours after the SPR announcement was made. And just this morning, we broke even above that high that we saw on Monday to test a new higher high. We still haven't gotten back to last week's high, but we're above the trend line resistance, and President Biden has just compromised national security for the sake of what? To game crude oil prices down for one lousy day. These SPR releases have never worked before, they're not going to work now, and this is reckless policy. Now, this particular announcement came with the angle of, it's going to be an SPR time spread trade, very technical sounding. It just plain doesn't pass my smell test. This is bullshit. I'll debunk all of that as we get into the post-game segment. We'll also talk about the Nord Stream 1 pipeline being throttled back to 20%. It's very clear to me that Putin is starving Europe for gas, but giving them enough to hang on at least till the fall, not allowing them to rebuild their supplies. We'll also talk in the post-game segment about the big picture state of the oil market and my perspective on why we're in the very early stages of a global energy crisis that will last for the balance of this decade. But Adam Rozencwajg has some very similar views. I want to give him the courtesy as our guest of allowing him to share his views first. We'll get to my version of this in the post-game segment. Coming back to near-term outlook for the crude oil market, to get really bullish, we would need a pattern of higher highs and higher lows. Now, we've already got a formative pattern of higher lows. We've got a very short-term higher high in the sense that this morning's high was higher than Monday's high, but not higher than last week's 100.90 something, whatever it was at the end of last week. Breaking out above the 100-day moving average, which is right now around $101 on WTI, that would be the real bull signal in my mind that would say we've got the pattern of higher highs and higher lows and that we're moving to substantially higher prices. I have a gut feeling we're headed there, but let's wait and see what the market actually tells us. Despite other signs of bottoming, though, time spreads are actually collapsing. Now, remember a few weeks ago when I told you even though the flat price of crude oil was collapsing, those time spreads were telling us that the market was incredibly tight, and that was a bullish signal. Ironically, now as we're seeing signs of bottoming on the flat price and maybe the beginnings of an incipient recovery, those time spreads are collapsing. And the message there is basically that the market is still very concerned about the settlement of the September contract, but after that, they're not nearly as concerned as they were a few weeks ago about being able to settle subsequent contracts as we get into the fall season. So there's a conundrum there between what the term structure is telling us and what the flat price action is telling us. I'll have much more to say about crude oil after we do an energy-centric interview with Adam Rozencwajg in today's feature interview.
All right, well, let's move on to gold because even if we were talking about it yesterday or the day before, it would have been the same thing of, gold is weak and things are quiet and there's no sign of a pulse. But just today, on the day of recording, we had a pretty substantial gap higher in both gold and silver. Silver up over $1, gold up $50 an ounce here. And it just seems like it came to life. And now one day doesn't make a new trend, but what's your take on this and what do you think?
Well, Patrick, maybe it's the dovish 75 basis point hike that got called dovish that's helping us. I'm not sure. You would think that with increasing interest rates, or policy rates at least increasing, even if the back of the curve is not increasing, that that would mean that gold would have a headwind, but it seems to be a tailwind. I don't really know. I welcome the news. It does seem like there's new life coming into the gold market. We're nicely above not only just the short-term moving averages, but just today we broke above the 21-day moving average, which had been resistance through yesterday. And the 34-day moving average comes next at 1775. So we'll see what happens. So far, so good. I would say, though, I don't have a good explanation for why it's doing so well. Our friend Jeff Christian over at CPM Group had a video out last week saying he thinks this is the calm before the storm, and there's probably going to be much lower prices to come before this is over. So we'll see how it plays out.
All right, well, let's wrap up with touching on that 10-year Treasury yield, which now is decisively below 3%. Just in the last 5-6 trading sessions, we've broken all the way down to 2.68% at the time of recording here. What do you make of this? I mean, this is like a 3-month low on yields. You think it's some meaningful?
Well, certainly the 75 basis point hike at the front of the curve yesterday didn't do anything to transmit to the 10-year. It suggests to me that the market thinks the dovish pivot is imminent and they're not as worried about inflation continuing. So did the economists just call that peak of inflation a little bit early in Q1 and surely it's by now it has to have peaked? Or could it be that secular inflation's a bitch and everybody's confused because we haven't seen it in 40 years and maybe it's actually here to stay? I don't claim to know the answer. Time will tell.
Well, this week's feature interview guest is Adam Rozencwajg. Eric, why do we get Adam on the show for our first-time guest?
We've had quite a few listeners request Adam because of his writings on the natural gas market and the formative energy crisis. Many of the views that Adam has about spare capacity having run out globally in the crude oil market, I share. We've talked about those in the past. But he also has some very interesting views on natural gas that certainly was outside of my circle of knowledge and expertise. I think you're going to find that fascinating. We'll touch briefly on the fertilizer crisis as well. Adam's partner, Lee Gehring, is the expert in his firm on that subject. We've got him scheduled in August for an interview so that we can give you some deeper perspective on the fertilizer crisis, what drove it, and why it's not just a function of the Russia-Ukraine war, as so many people are inclined to write it off as. But I think you're going to really enjoy Adam in this week's interview.
Well, Eric's interview with Adam Rozencwajg is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is Adam Rozencwajg, managing partner for Gehring and Rozencwajg. Adam wrote a terrific research piece back in May that really captured my attention. Listeners, you'll find a download link in your Research Roundup email for that piece. I strongly encourage you to read it, as it really is going to provide a lot of excellent background for today's interview. Adam, I want to start with the big picture here. I think we have a dual crisis facing the world, both an energy crisis, which I've been paying a huge amount of attention to. I don't know as much about the agriculture and food crisis and the fertilizer issues. I know that your firm has done a lot of research on that, but the feedback I get consistently from everybody is, look, Eric, these are just manifestations of the war between Russia and Ukraine. As soon as that blows over, it'll all be done with. That's not what your research reveals, is it? Tell us the backstory on this. How do we get to a point where all of a sudden the world seems to be facing energy and food crises?
Yeah, well, first of all, thanks for having me this afternoon. I completely agreed. This is not a Russia and Ukraine crisis, although the situation there is certainly making things more complicated and making things tighter. But, we first wrote on the verge of an energy crisis back in the summer of 2020, and you'll recall then that oil prices had been negative in April of 2020, minus $47 a barrel, and they were still bouncing along, at very, very decade low levels. We had shut in wells all across the country, and so in a lot of ways, it was a strange time to write an essay called On the Verge of an Energy Crisis. But what we saw and what we continue to see is a market that was slipping into deficit, and that deficit was getting worse and worse and worse. So fast forward, and we can talk about the reasons why, but fast forward to the beginning of 2022, and when Putin invaded the Ukraine, so many investors and market watchers really were caught off guard, and they said, we just really couldn't have seen this coming. And I think nothing could be further from the truth. This was a train wreck happening in slow motion. For 2 years now, inventories around the world have been declining, which means that demand has been running ahead of supply. Energy prices have been moving higher. Energy stocks have shown leadership. And yet we've seen no capital response. No money has been put back into the ground in any of the extractive industries, really. And that's just been ratcheting this market tighter and tighter and tighter. And now that it's reached its boiling point. So a lot of people, like I said, consider this to be completely out of left field, but the fundamentals here have been setting up for a long time. We cut spending on oil and gas, into the pandemic, we cut it 75, 80%. We're still substantially below the 2019 spending levels, which in and of themselves were not enough to maintain flat production. All of the growth in the last decade has come from the shales. There's been no growth in the rest of the non-OPEC world, and there's really been no net growth in the OPEC world either. So all the supply growth in the last decade has come from the shales. We have blindly believed that those shales can grow infinitely, and I understand why. They were fantastic new sources of supply. Bringing on the shales in the 2010s was the most important development in the oil business since the super giant fields of Ghawar were brought online in Saudi Arabia, 70 years ago. But even the biggest oil field is not infinite. And we've reached the point now where those fields are showing their age. They're beginning to exhibit depletion. And we just have neglected this industry so terribly for almost 10 years now that we really just don't have anything in the way of capacity ready to backfill depletion in the shales. So that was true in 2020, 2021. The market was just getting tighter and tighter and tighter and tighter. And then you have a black swan event, something that no one was able to predict. And now we've just tightened the market dramatically more. But this is not a Russia story. And these problems will persist, for years to come now.
Adam, we are in strong agreement, but I think as a journalist here, I have to play devil's advocate and take the other side, which is, a detractor might say, hey, wait a minute. Ever since the beginning of June, the flat price of crude oil has sold off dramatically from $124 down to, we got down to a 90 handle. We're bouncing off of that. It looked like just overnight last night, we were finally breaking that downward sloping trend line. And sure enough, it looked like maybe the market was bottoming and starting to turn back up again. The White House came out today on the day that we're speaking, which is Tuesday, a couple of days before this podcast will be released to listeners. The White House announced another 20 million barrels would be sold from the Strategic Petroleum Reserve for the purpose of trying to game gas prices lower. So it seems like, in the eyes of some observers, like, look, the White House has been using SPR sales to get the prices back down. They're going to keep doing that. The war ought to be ending. That should take some of the pressure off by the time they stop. So what are you guys so worried about? And I know that the thing that I cite is even in this flat price sell-off, we've seen a tightening in the form of backwardation in the WTI term structure, where the time spreads were actually increasing on some of the days that we saw the biggest sell-offs in flat price, which I think is unprecedented. That's the reason that I see this as, despite the fact the recession maybe is going to take care of some demand destruction to take the pressure off in the short term, I still think that much longer term, we're at the beginning of an energy crisis that will last many years. My reason is mostly focused on that backwardation. How do you see it, and what leads you to the conclusion that this problem's not going away?
Yeah. So look, I do think we are in agreement, and I think we're in agreement for a lot of the same reasons. I'll maybe add some of the points that you mentioned here. The backwardation points to a very tight market, and I agree with that 100%. I think ultimately what's causing this tight market is the fact that we've dramatically underinvested in the oil and gas industry, and there's two reasons for that. One is why that happened in the first place, and the second is why it's lasted as long as it has. So one of the reasons why we've invested so little is because commodities are cyclical, and they go through periods of time where they're expensive, and companies earn really high rates of return, and money's attracted in, and that money ultimately gets put to work. And that sets up for too much supply and a big bear market. And we had that, 2010, 2011, in the decade before that, everyone was talking about peak oil supply and Hubbard's curves and things of that nature, including us. There's a very real sense that the supply was becoming unsustainably tight. A lot of, crude prices rallied. A lot of companies were able to raise a lot of money. And that probably was going to set up for a bear market regardless. But one thing happened that was even more dramatic was that, that money got put to work, and it discovered didn't discover is not the right word because we always knew the shales were there, but figured out a way to liberate the oil from the shales. So not only, was this going to be a regular cycle, but the cycle is probably going to be more pronounced than normal cycles because the efficiency of that money that was put to work last cycle was really, really high. We found a great new field. That doesn't always happen. Sometimes we do, sometimes we don't. And sometimes the quality of those reserves are more middling. But this was a real doozy of a new set of fields, really 3 fields on the oil side, the Bakken, the Eagle Ford, and the Permian. So that set up for a pretty bad bear market. And then ESG concerns and ESG pressures meant that when the market did finally tighten, when we did work off that oversupply, and when we ended up in a situation of pretty clear and demonstrable deficit, normally capital would start to come back in, but we've not allowed it to do so because of ESG pressures. And even today, you have very, very little. In fact, I think no energy IPOs or secondaries or bond issuances. There's no capital being raised into the space. And you'd say, well, fine, but aren't they making all this cash flow? But they're returning all that cash flow hand over fist. So, to me, that's the real crux of why we're in this energy crisis. And it'll ultimately be alleviated only once that money gets put back to work. So how to address the concerns of the bears who think that, look, perhaps prices are coming off and we're going to have a recession and perhaps things can resolve themselves in the Ukraine. And what I would say is that, you have to be very careful when you read the tape and try to infer fundamental developments from price actions. And in the oil market, we've have this hyper financialized oil market where the paper trades are multiples of the physical market. And people have been putting on a recession basket now for the last 3-4 weeks. And we've seen that, across the board. If you look at the sectors that did really badly in the summer of 2008, they're the same sectors that did really badly in the summer of 2022. Materials, energy, financials, and industrials. Despite the fact that the market's really different today than it was in 2008. But I think you're seeing this knee-jerk reaction where traders are saying, look, get me what worked in the last recession, get me what, sold off in the last recession, I should say, and let's put that on, despite the fact that, the financial system today is the banks anyway, and as part of the financial system are much less impaired than they were in 2008. And energy is 4% of the S&P. It was 16% of the S&P in 2008. Really, really expensive. So the market's really different, but people are kind of putting on that same trade, and I think that's working its way into the oil markets as well, since you do have so many equity-like products that are tied to oil prices and things of that nature. But you're absolutely right. We saw the oil price sell off at the same time as the term structure tightened. And, the backwardation increased. People are saying that's unprecedented. I've gone to look back. I can't find an example of that having happened in the past. So, we're looking back farther now. But yeah, as far as we can tell, that is pretty unprecedented. And, as far as the SPR goes, so basically what I'm saying is you have a spot price that's selling off, but you have an underlying physical market that's screaming for telling you how tight it is. And to me, I would believe that physical indication more than I would believe the spot price, which can be certainly, I don't want to say manipulated, but can be certainly overwhelmed by paper traders that are just trying to, put on an algorithmic basket of whatever worked in 2008. As far as the SPR goes, clearly the SPR release has never worked in the history of the SPR. It's been done, a handful of times, not to this extent. And it's always resulted in higher oil prices down the road. I don't think it causes higher oil prices, but I think there's a coincidence where SPR releases occur when the market's super, super tight, and they ultimately can't take the oil price down on any type of a sustained basis. So maybe you get a trade down when those things are announced, and then 6 weeks later oil prices are higher. And this is clearly a case of that too. But one thing that I would tell you that I think is really scary as we go into the second half of this year is that in the first half of every year, we tend to build inventories, and the second half of each year, we draw them down. And this year, we didn't build inventories in the first half, despite the fact that we have had an unprecedented, record-setting, sustained release from the SPR. We have become addicted to this SPR, 1.5 million barrels coming out. And it's just clearly not sustainable. And so as we go into the second half, the White House is announcing another 20 million barrels. They're saying that's it. In any event, we're going to start to get quite low on the SPR, probably come the third and fourth quarter if we continue at this pace. And so what's going to happen to the oil markets when that 1.5 million barrels on a global basis that we've become completely addicted to, that has been absorbed into the system through strong demand and faltering supply? What happens when that pulls back? And I think that that's where you could really see, a spike to $200 oil is not out of the question in the second half of this year. So, I think that's a really kind of sobering thought here. It's never been able to work in terms of being able to sustainably depress prices. And quite frankly, it's exactly the wrong thing that the market needs. If you agree that the energy situation we find ourselves in is because we've underinvested in the energy industry for the last 10 years, what you should be doing as an administration is encouraging policies that'll help supply. Whereas everything we've seen thus far has effectively been policies to help the consumer, which is exactly the wrong thing to do, right? All that does is help to stoke demand. Releasing barrels from the SPR, talking about reducing tax on gasoline to help the consumer, and then threatening, to shut down crude exports, which would be a disaster because it would effectively decrease the efficiency of the refining system. U.S. refiners are not really set up to process U.S. crudes. All these things don't do anything for the oil companies, and what you need to do is show a little bit of change in sentiment, solidarity, and support for the E&P industry, and say, look, we understand you guys need to put money to work, and this negative rhetoric that we've been having for the last 10 years will stop. And one other thing that I'll just kind of mention about the SPR, which is interesting, all these crack spreads, or the spread between the price of refined product and the price of crude oil, have been extremely high, record-setting highs. And, at times, gasoline and diesel has traded at the implied value of, $200 a barrel plus. And people talk about that sort of anomaly, but we began to wonder here if those prices aren't really the right prices. There's no SPR for diesel, there's no SPR for gasoline. So here you have a market that should be trading maybe at, $200 a barrel oil, and you're depressing the oil side of that equation by these releases from the SPR. Could that be what's happening here? Again, a really, really sobering thought. So I think all told, we're set up for a very, very, very tight second half of this year, and one that is going to be dangerously tight.
When it comes to an outlook for oil prices in the second half of the year, I have to be honest and say, I don't know which way it's going to move next, because although I couldn't agree with you more that we've got a really serious problem, it's also true that commodity markets can't be forward-looking like the stock market is. We can't really talk about what ought to happen next year and how that's going to affect the price today, because we have to balance supply and demand in the moment, right here and now. So if this recession is really deep and bad, which I think it could be, that could result in enough demand destruction that takes the price of oil down another $20 for all we know. But I'm going to make this argument, Adam. I contend that we've already reached a point where it is not possible for the global economy to return to its pre-pandemic condition, because my contention is if we got back to pre-pandemic demand, there simply is not enough supply to meet that demand. It doesn't exist. The investment hasn't been made. And that means we're stuck. We're in this kind of zombie economy where even if we get through the economic cyclical factors that have led us into what looks like a very serious oncoming recession, even when that recession ought to be ending, I think we stay stuck in it, because as soon as demand starts to recover, energy prices go through the roof to the point where they cripple the economy and prevent recovery from that recession. And I think it potentially has the ingredients to turn a recession into a much longer lasting depression, because you can't get out of it due to energy crisis. Am I crazy to think that? And is there any reason to maybe see another side of that story that I'm missing?
Well, look, I do think that energy is central to the economy, and that shouldn't be a controversial statement, but I think it has been for a long time. But, to me, all economic activity is transformation of energy from one form to the other, and it stands to reason that you should have a fairly robust, stable, available, reliable, and ideally inexpensive energy supply to be able to fuel that. And so, yeah, I do agree that that's going to be an impediment here going forward. One thing that I would point out if you actually look from an investment perspective and from an investor's perspective, some of the best times to be involved in the resource markets and even in the oil markets have been during periods of time that have been historically associated with really poor economic growth. And the most notable example of that would have been if you looked at oil stock prices from 1929 on the verge of the Great Depression and the stock market collapse, through to the end of the 30s. A basket of oil stocks was actually, slightly positive over that period of time. And if you did a commodities stock producer basket with a quarter gold, a quarter energy, a quarter base metals, and a quarter ag, I think you were up about 85, 90% over that 10 years. The stock market was down 50%. And why is that? Well, commodities were really, really cheap going into that period. Capital had been starved in the extractive industries throughout the 1920s. And so you had a situation where high commodity prices effectively, were able to drive stock prices despite the fact that this very poor macroeconomic backdrop. The same thing in the 1970s. The 1970s is not considered to be a period of robust economic activity, although it's actually the numbers are better than I think is commonly perceived, but nevertheless, not a period of strong economic activity nonetheless. And yet commodity stocks and oil prices did extremely well. There's the only place to hide. Again, it's because we didn't invest in the industry in the 1950s and in the 1960s. And then in the last 10 years, we've had all this malinvestment across the board, but in the energy space, we've had a huge amount of malinvestment going into things like wind and solar and decommissioning fossil fuel plants and decommissioning nuclear plants, which is the dumbest thing we ever could have done. And we were able to do that because we had this backdrop of cheap, abundant, reliable energy. And I think that people understand that cheap capital can result in malinvestment of dollars, but they don't understand quite in the same way cheap energy can result in the malinvestment of energy. And that's exactly what we've had. The last decade has seen a huge proliferation of energy technologies that themselves are very energy intensive. Wind and solar is hugely energy intensive and hugely capital intensive. So you have cheap capital, cheap energy, and what do you have? Windmills and solar farms. And I don't think there's any coincidence to that. So we're in a period now where we don't have that anymore. We don't have all that cheap energy. And I think a lot of the playbook for the last decade or 20 or 30 years has to be reconsidered because we just don't have this resource base that we did in the past. And people get that with the supply chain, which in a lot of ways is a lot more complex. Post-COVID, people realize we've whittled down the supply chain so much that it's unsustainable. We'll probably have to restock it. But nobody realizes that we've whittled down our resources base by not investing in them in the last 20 years. And, those are going to have to be rebuilt as well. So I think it argues for, a decade of high prices that need to attract capital, normalize asset values for real assets relative to financial assets, and ultimately get that money spent and in the ground again.
Adam, I could talk to you for hours and hours about crude oil because it's what I trade and what I know about. But our listeners have heard quite a bit of that from me already. And you've done some terrific research in the natural gas market, which I don't trade and don't have as much knowledge of. Please, let's start with the big picture of why is it that historically natural gas in the United States has been much cheaper than in Europe? Why was that true? And more importantly, why do you think it's about to change?
Sure. And, that never was true going back, 20 plus years ago. Natural gas prices were expensive. Gas was dear in the U.S. as well. And, probably culminating with Jimmy Carter, asking everyone to turn down their thermostats and things like that. So, there's a wide held belief that natural gas in the U.S., we were running out of natural gas. And in fact, the first LNG facilities in the U.S., and I was actually at the ribbon cutting of the first one, which was the Cheniere Sabine Pass facility down just outside of Houston, was actually commissioned to be a LNG import terminal because there's a very widely held view that we were running out of gas. And we were running out of conventional gas. And then what happened was the U.S. unlocked the shales. And again, basically doubled U.S. gas production in a period of 5 or 6 years after having steadily declined over a period of decades. And you cannot overstate how important the shales were. The Marcellus in and of itself, one of the most important hydrocarbon basin discoveries in the last 50, 60 years. The Permian Basin as well. the Eagleford as well. You put them all together, all in a span of 10 years, the most transformative moment in the history of energy that we've really had. And that depressed U.S. prices. And natural gas, unlike oil or coal, is really difficult to transport. You can't move it around because it's a gas. So you have to supercool it until it's a liquid. It's very expensive. It requires a lot of special equipment and very large equipment, large capital expenditures. Really kind of the realm of the super major. And so that LNG was always a bottleneck, and it created these pockets or these islands of natural gas where the market would be totally dislocated. And the U.S. was a perfect example of that. So throughout the 2010s, you could see gas prices in the rest of the world at 12, 15, 16 bucks and, $2 in the US. And more recently, last winter, going into last winter, gas prices spiked to be $30 to $45 in the rest of the world and were as low as $4 in the United States. And again, just to really kind of put the whole gas market into perspective, which I think is a wild statistic, with the exception of oil trading negative, natural gas at $1.91, which is basically in real terms the cheapest molecule of energy in human history. And that was done in 2020 during COVID. And then by 2021, we hit $50 an MCF, which on an energy equivalent is like $350 oil, which is the most expensive molecule of energy in human history inside of 18 months. So, when people say, is what's happening really a big deal? I mean, yeah, this is a big deal what's happening here today. And people, I don't think, fully appreciate it. So even today, as we speak, natural gas prices in the U.S. have rallied, but they're like $9 here today, $8.99, which is high even in this cycle here. They were as low as $5.50 kind of 2 weeks ago. And in the rest of the world, they're still sort of $35. So how can you have this huge arbitrage? Well, we export a lot of gas. We're actually the world's largest gas exporter now, having gone from an importer to the world's largest exporter in less than 10 years. But we still basically produce more than we export. And so we still have excess supply in the US. There's still a bottleneck of export capacity. And so what we wrote about is we said, look, what I think people are missing here is that natural gas can really move. We've seen that in the past. It's a commodity that's really priced on the marginal unit of supply. And so it can really swing in a hurry. And what people don't appreciate, and this was, back in March and April when we wrote this, gas was between $4 and $5. It could be 40 before anyone knows it. It can just happen really, really fast. And the reason for that is that if you get any excess spare capacity on any of those LNG terminals, arbitrage theory tells you that you should lock the US price into the world price. And it was that asymmetry that was really interesting for us. Could gas price trade down? Yeah, it totally could. The gas industry hasn't made money in a long time. It could drift lower, but it could go up tenfold potentially in a period of weeks, really. And people thought that was sort of outlandish. But by the time we actually published the essay, gas had already doubled, gone from 4 to 8 on its way basically to 9.32 was the high back in June. Now, the next question would be, why would we have excess LNG spare capacity? Well, one reason could be that we build more, although that I think is unlikely in the near term. We do have some new capacity coming online, but nothing imminently, more in the next kind of 12 to 18 months. So that could do it. The other thing, of course, could be if supply began to falter. And so that led us to then say, well, what are the supply trends in U.S. natural gas? And what we came away with was quite fascinating. Number one was that there was very little, if any, research being written on it. So if you look at the sell side community and all the Wall Street analysts or even the energy analysts, no one was talking about could the shales actually begin to peter out. Everyone was just under the impression that the shales would go on growing forever. So that was number one. Just no one was even looking at this, which is always a good sign. And number two is that actually when you look at the Marcellus, which has been basically 100% of the growth in the last couple of years, it hasn't really grown in the last 12 months. You're kind of flat production there year on year. And so, everyone thinks that the shales and notably the Marcellus or just this sort of mighty Marcellus can keep on going forever. But there's a lot of reason to think that perhaps it's beginning to show early signs of depletion. If that happens, then forget it. If you start to actually roll Marcellus production over without any new shale basin, and by the way, there's no new shale basins that are kind of waiting in the wings here to backfill that, you could in a hurry have some spare capacity on those LNG terminals, and then all of a sudden you could lock the US price in with the world price, kind of overnight, so to speak. And to us, that made that investment really, really attractive. So we wrote this big essay. We positioned the portfolio accordingly. We'd been early to the gas market. We've been involved all the way since the fourth quarter of last year. And so, we've been enjoying that move. And then no sooner did we write all that, then the Freeport LNG facility down in Texas caught on fire and had to be shut down. And that's a 2 BCF a day LNG export terminal. It's about 20% of U.S. gas exports. And it was unclear how long it was going to be down for. The preliminary indication said it would be down for 2 weeks. So 14 days, 2 Bs a day, you're talking about 28 BCF of backed up gas that was expecting to get out of the US that couldn't get out of the US, right? And so when you look on the inventory side of things, inventories were at a 350, 360 billion cubic foot deficit relative to average for this time of the year. And so 2 weeks at 2 Bs a day, that wasn't really going to move the needle too much. But very quickly, it was concluded that it would likely be offline for 100 to 150 days. So now if you're talking 150 days times 2 BCF per day, 300 Bs, you could start to repair a lot of that inventory situation and actually have a sort of dodge a bullet, if you will. Now, the gas names had sold off, so we didn't really lighten any of them, but we were watching it very closely. And a funny thing started to happen. Inventories in the US, you should expect that they would begin to build now that you have 2 BCF a day less of export demand. They haven't. And the deficit relative to average has actually gotten worse. And I think that's because demand has been very, very, very strong. At the same time as supply really hasn't been doing much in terms of growing. So, you've had some warm weather. We would have been in an even tighter situation, I suppose, if we had been exporting gas. But that idea of Freeport catching on fire and fixing the world's inventory situation, I don't think that's going to happen this year because I think all that gas is being consumed. So here we are today. We're actually at a nearly 400 BCF deficit relative to normal. So things have actually gotten tighter despite the fact that Freeport's offline. So, we continue to be really, really bullish on U.S. natural gas. Again, depending on where your listeners are, if they're American or Canadian, they really don't appreciate how dramatic this is in the rest of the world. In the rest of the world, you have gas prices that are between $30 and $40 an MCF versus here, $7 to $9 and hitting $9 today. But, the same way that gasoline prices are sort of tabletop conversation in America, natural gas prices are the subject on everyone's lips in Europe. And, we just got back from Germany. The Germans are basically resigned to the fact that they're not going to have electricity this winter. And obviously Putin, just today is taking down Nord Stream 1's volumes down by 80% and, continues to play geopolitical games with the gas supply. So this is a really, really dangerous situation for the rest of the world. It's not appreciated here in the US. And these gas names are trading at, like 1 and 2 times earnings in some cases. So, just really, really, really good value as well.
Now, just looking at the natural gas futures contract, it started selling off sharply, exactly the same time that oil started selling off sharply in the beginning of June as the market began to price in the reality of the oncoming U.S. recession. Makes perfect sense. Sold off hard just like oil did. But hang on a second. Right around the 1st of July, oil continued to sell off. Nat gas made a U-turn, and it's almost, actually at one point this morning at the peak, it had, I think, fully retraced the entire move down since June. We got nothing close to that. We had a tiny little recovery where we broke a trend line just for a few hours, and then Biden announced another SPR draw. What's going on with this huge disparity where both markets sold off almost in unison until the beginning of July? What happened at the beginning of July?
Well, I think in the U.S. it's been the inventory situation, and I think that's mostly explained by warmer weather. And so we do have a heat wave now throughout big parts of the country, and New York has been over 100 for the last couple of days, and that really does begin to crank up gas demand. And so I think that has helped things, but I think it's also the realization that inventories here in the U.S. are not building. They're just not building it. They're very, very, very stubborn. And from when Freeport went offline, everyone just expected that inventory situation, which was approaching dangerous or on a trajectory towards dangerous, to all of a sudden ameliorate. And we've had just the opposite. So now we're in the situation not dissimilar from what Europe faced last year, where Europe, in May and June, after a really cold winter, coming out of 2020 into 2021, their gas inventories were really low. And they figured that they could slowly chip away at that deficit and rebuild enough inventory throughout the summer so that they would go into winter 2021, 2022 with good, ample stocks. And that just didn't happen. It didn't happen for a variety of reasons. It didn't happen because Russia was also in a situation where they needed to rebuild their inventories. And everyone thinks that Russia kind of turned off the gas last year. They really didn't. They just didn't provide gas over and above what they had agreed to contractual minimums, right? So they had some discretion there. They didn't give them extra gas. We can debate all the geopolitical reasons, but a big reason for it that's underappreciated is just that Russia was really low in their stockpiles also because they had a cold winter too. So now all of a sudden, Europe in the middle of last summer said to themselves, well, we're not filling the way we want to. Let's turn to the LNG markets. But it turned out that all of that LNG was being sucked and sent to the Asian basin. And so that LNG volume that everyone had just expected to be sloshing around wasn't there. And that's when the panic started to set in. So a different set of circumstances here. We're not talking about pipeline gas from Russia coming to the US. That's obviously not a thing. But, similar dynamic insofar as inventories were really low at the beginning of the season. I think everyone expected to be able to chip away throughout the summer. Through June, it wasn't entirely clear that could happen. Then Freeport fire came and we said, okay, this will be our reprieve. This will allow us to get those inventories filled again. Gas sold off, oil sold off as well. Everyone's worried about a recession. And then it's just like, oh my goodness, that's not happening. And here we are now, at the end of July. It's going to be very difficult to see how inventories can fix themselves before the end of the injection season and into the withdrawal season. And that's a pretty scary prospect.
Adam, I want to just challenge a couple of assumptions. I think your arguments are brilliant, but my job is to think about what might be another side of those stories. It seems to me there are a couple of questions that come to my mind on both logistics and on the supply issue. Let's start with the supply issue. Your whole argument is basically, look, there's no more shale basins that are going to be invented out of thin air. We've got the ones we've got. That means that there's not a whole lot of supply coming online. And so, therefore, as we develop the export capacity to be able to liquefy that U.S. natural gas, put it on ships and sell it on the global market, once we get to the point where we can use up the available excess that exists in the U.S., which causes these artificially low U.S. gas prices, you're expecting U.S. and European gas prices to converge. Makes perfect sense, but hang on a second. A whole lot of shale gas that's produced today is literally wasted. It goes up in smoke because you have shale oil wells, which also produce a whole bunch of shale natural gas. And for logistic reasons, at the time those wells and oil fields were developed, they didn't have a gas pipeline. They didn't have a good way to get the gas out of there. So they flare it off. And for any listeners who are not familiar with this process, if you've ever seen a picture of an oil field that has these smokestacks with fire coming out the top of them, it's called a flaring stack. They literally don't know what to do with the natural gas that gets produced as a byproduct of the oil that's being produced. So they burn it up and throw it away. Well, if all of those flaring stacks around the United States are throwing gas away and all of a sudden the price quadruples the way you're predicting, I have no idea what it takes to, rework an oil field and get rid of the flaring stack and install a pipeline. But I would think that price impetus would create a lot of motivation to say, let's stop wasting all of this flared off gas and let's capture it and export it instead. So would that be a source that kind of changes the supply equation? Have you looked at that?
Yeah, and absolutely. And flaring of natural gas is obviously a very controversial practice in the U.S. It's emits CO2 and effectively is wasted. So you're not, it's just CO2 with no discernible work being generated on the other side. I don't have the numbers right in front of me in terms of how much gas is flared today. But one of the things that I would say is that we don't have a robust oil drilling boom taking place right now either, right? So, it's not like we're getting all this byproduct gas coming out of the Permian in the way that we had in years past, which was a really big issue in keeping gas prices lower for longer, because, even when the gas weighted E&P companies that really focused on gas fields were having difficulty making money, you still got new supply coming online from the oil fields that effectively, had no marginal cost associated with that gas because, as you said, it was a byproduct. So that's still an issue, but it's not the same as it was because we don't have this robust oil drilling boom taking place. But one thing that I would say where gas is a little bit different than oil on the sort of medium term, gas is an easier molecule to work with. It's easier to flow gas molecules through tight rock than it is oil. Oil molecules are much longer hydrocarbon strands, and there's a lot of technical reasons that make them slightly more challenging. And there's also, we do have some sources of natural gas that we could tap into. Notably, there's a whole section of the Eagleford Shale, which is predominantly thought of as an oil shale, that has been left there because it's all gas and has no oil. And so people said, well, gas is so cheap, we don't really want to be involved there. So, there are places that you could go to up in Canada. The Montney Shale is a very high quality gas weighted shale. So there are areas, none of it is going to really kind of save us in the short term. We do have quite a tricky situation here. Ultimately, I do think that those sources of supply probably will come online and help to meet strong demand. And you have to be careful when you look at any commodity market, and you look at any commodity market sort of truthfully as a value investor, the way we try to, these markets are cyclical. And so the price response at some point will incentivize development and we will bring on supply, and it's very likely we'll overshoot the mark. In oil, it's a little trickier to see exactly where that's going to come from, in the sense that I couldn't point to any, undeveloped field ready to go. And gas, also going to be tricky, but I think you probably do have sources of supply. But none of them are coming online immediately, and none of them are going to stop a bull market from taking place between now and then. So, these are ultimately all cyclical industries, and this cycle, I think, is going to be more pronounced because it fell farther because of the shales and all the supply that brought online, and then it was held down a lot longer because of ESG pressures. And so that's just going to make for a very, very, very tight market here for some time to come. But eventually it'll end as well.
Now, your investment thesis is based entirely on the idea that U.S. and European gas prices, and we're talking now about natural gas, not gasoline, those prices ought to converge. It seems to me that's entirely dependent on the viability of an arbitrage between those markets. As you just said yourself, 20% of U.S. export capacity for LNG was taken offline with the Freeport fire. So is there a whole bunch of new gas export facilities being built that I don't know about? And I'm not asking that rhetorically. I literally don't know. I don't follow the gas market. It seems to me for your story to play out, we got to be able to export a whole lot of gas onto ships. And I'm not sure if the ships exist or if the export terminals exist or if the import terminals exist in the other countries that need our gas. How does that all fit into this story?
Yeah, absolutely. So, I think you're totally right. I think so long as Freeport is down, that infrastructure bottleneck probably will persist at the LNG liquefaction side of the supply chain, and that will prevent the arbitrage of U.S. prices from global prices. No two ways about it. But what I had been worried about, even if you take the long view on when that's going to come back online, it should be back online by year end. Now, what I had been worried about initially was this idea of inventories, because stockpiles and inventories can provide a buffer. And so they can, really do a good job of being able to bridge a particularly tight market for a period of time, right? I mean, that's what stockpiles are there for. But if we had the situation where stockpiles were extremely low, then you take Freeport offline. As soon as you bring Freeport back online, your problem's there again, and that bottleneck potentially begins to dissipate. It was unclear how inventories would repair when Freeport first came offline. And what's astonishing now is that they really, really haven't built at all. In fact, they've gotten lower relative to seasonal averages. So I agree. I think that the convergence probably has to wait for the Freeport facility to come back online. But the big question there is, as soon as it comes back online, do we hit that point? So is it something that's going to be a fourth quarter event? Or were you able to rebuild inventories, build this cushion and buffer, and now it's sort of a late 2023 event? We're long-term investors, so either way, it doesn't make a huge difference to us. But whereas I would have thought originally perhaps it had been pushed out to next year, I'm not so sure anymore because we're not building that buffer back.
Adam, I want to move on to a couple of other excellent topics that were in your letter. You talked about the fertilizer situation globally. Give us just the quick outline of that and tell us what people can expect to find when they read that excellent coverage that you have in your letter. Same thing on gold. You say we're getting close to time to buy gold. Why is it that you guys had gone neutral on gold a while back, and why do you expect to fairly soon get bullish on gold?
So on the fertilizer side of things, you really can't imagine a more perfect storm. It's just sort of been buffeted on all different sides. So there's three main types of fertilizers. There's nitrogen, phosphate, and potash. Nitrogen is made from natural gas, and to the extent that we have a natural gas shortage, we've seen a lot of nitrogen fertilizer capacity come offline around the world. So that should really tighten that market, and it has really tightened that market. On the potash side of things, the phosphate side of things, Russia and Belarus control a large amount of the world's potash and phosphate production. And that's obviously being disrupted now because of the Ukraine-Russia conflict. And so I think you're going to run the risk of potentially having supply shocks there as well. And then just from a straight growing perspective, this is not fertilizer, but this is just grain prices. And of course, if grain prices move higher, that means that farmers have more income and they tend to spend more on fertilizer. But from a grain price perspective, the Ukraine and Russia both are huge grain exporters, and wheat in particular in the Ukraine. And that crop has both been disrupted in terms of being able to be harvested, and then shipments are now being disrupted as well. And of course, as I'm sure your listeners know, the Russians have been shelling the port of Odessa, and that's now resulting in even more bottlenecks. So there had been some hope that perhaps we'd gotten past some of that, and that looks a little bit less likely now with the recent hostilities in those port towns. So, I think from an agricultural perspective, we're in a really, really tough spot. Stockpiles are fairly low around the world. Demand for all kinds of grain has been so strong in the last 10 years, so strong. And it's really been, an emerging market story. As countries get richer, they want to consume more protein that's really grain intensive. And so demand has been there, but it's been met by year after year of bumper crop. Now, how do you get bumper crops? Well, everything needs to be firing on all cylinders, and you need to apply a lot of fertilizer. And we're just not going to get any of that this year. We're not going to get the same fertilizer applications because of disruptions and because of gas. And we're not going to just get the same amount of actual acreage because of the conflict in the Ukraine. So I think the ag market's really tight. As far as gold goes, we got out of the gold market very well. We got involved in 2018, and we got out of the gold market in the summer of 2020. And what we were seeing there was that the relationship between energy and gold had never been cheaper, in the sense that energy was never cheaper. And historically, whenever you get energy to be anywhere near that cheap relative to gold, which is when 1 ounce of gold buys 30 or more barrels of oil, it's always paid to get out of your precious metals and start to get invested in the energy space. And so that's what we did. And it was obviously a really good call. Today, I think things are, we see some warning signs on gold, and we see some things that are looking more favorable. Certainly, the gold to oil ratio has improved a lot as energy prices have moved higher and gold's moved sideways. Flow of funds has gotten more constructive as well, with Western speculators coming back into the gold market. So I think that the big risk to gold prices today is that we're still in a rate tightening cycle. And historically, that obviously is tricky for gold investment. We bought sort of a half position in gold stocks. We're probably a little bit early. We tend to be early on everything that we do, so that was no surprise to us. But, at some point, it'll be the time to bring that up. We thought perhaps it was coming as early as April and May, and it looks like we're a little bit early there. So getting closer every day.
Adam, I can't thank you enough for a terrific interview. Before I let you go, please tell our listeners what you do at Gehring and Rozencwajg and how they can find out more about the products and services you offer.
Oh, great. Yeah, please visit our website. We are natural resource equity investors. So we're not a research firm. Some people think that we are. We actually do manage money. All of our details are on our website, just Gehring and Rozencwajg on Google. Luckily, it's a unique enough name that if you can get it half right, you'll find the website. The website is GoRozen, GOROZEN.com. And we publish everything. It's all free of charge. So please go have a look, and I hope you enjoy.
And listeners, I really encourage you to read the first quarter letter that Adam and his partner Lee Gehring wrote, and I think you're going to want to sign up for that free subscription. I certainly plan to. Patrick Serezna and I will be back as MacroVoices continues right after this. After being completely sold out of advertising space for the last couple of years, we finally have capacity to add a new advertiser. MacroVoices has a PodTrack certified global audience of over 170,000 listeners, and each weekly episode typically gets 60,000 to 80,000 downloads. We have more than 20,000 accredited investors who have registered with us as accredited, and we estimate the total accredited investor audience as at least 40,000 accredited listeners, which we believe to be the highest number of accredited investor listeners of any podcast on the internet. We strive to accept tasteful advertising from advertisers whose product is likely to appeal to our audience. So we're looking for another investment or financial services advertiser to fill the space I'm speaking in right now. Mail order Viagra salesmen need not apply. If your company wants to advertise on MacroVoices, please email sponsorship@macrovoices.com for more information. Now let's get right back to the show.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Adam on the show. He just brought some fresh perspectives on the energy markets, just things that I haven't heard other guests talk about, but it really does put together a case that is very much in line with what you've been talking about up till now. What did you take away from the interview?
Well, Patrick, as a courtesy to you and our listeners, I'm not going to fully answer what did I take away because it would take another hour. I'll save my comments until we get to the crude oil chart, where I can talk to the chart and discuss a little more of my perspective. That's coming up in just a few minutes. Let's go ahead and get into the chart deck, though. Listeners, you'll find the download link for this week's post-game chart deck in your Research Roundup email. Now, if you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads above Adam Rozencwajg's picture. Patrick, the chart deck is titled Post-FOMC Market Moves. That means you have a crystal ball and are about to tell us exactly what's happening next.
Well, at least what just happened. How about that for accuracy? But anyway, the key thing here to look at is we were talking about this descending trend line pivoting around the 4,000 level, including the 50-day moving average and the fib zones all kind of lining up. And we were saying in order for the bulls to be able to put anything together, we would want to see them be able to demonstrate that they can actually put together a couple of bullish days that actually does some real technical repair work and start to turn the charts up. And really, we've over the last week have seen the bulls really start to get a little bit of momentum behind them. Now that we're trading above the 50-day moving average, what we have is a 200-day moving average that lies right around the 4,200, where all of the January, February, March lows have occurred. And often what were previous lows act as overhead resistance. So it'll be really interesting to observe whether the bulls now can put together, 100, 150 points over the next week or two and drive toward the upper resistance levels. I still am not sure that I want to flip fully bullish. While we went through a 6-month bear market, often there are these bear market rallies that often is just a pause of the previous selling, just simply because it's not going to just go crashing down, at least not every time. And what we can see here as we approach this is whether or not, as we get into September, October, whether or not the market starts to roll over again, or whether we really see that a meaningful market bottom is solidified. And that's the puzzle piece to solve throughout the month of August. Right now, on the short term, a little bit of follow-through strength towards 4,200 seems a path of least resistance.
Patrick, one of the things I've been reading online is a number of people are saying, look, a lot of hedge funds are really getting battered here because they were short. Could this just be the mother of all short squeezes, that we're going to see a large-scale short squeeze that kind of washes out all the shorts over the course of the summer and then things get negative again in the fall sometime?
Oh, you know what? I think if it was a genuine short squeeze, they'd have more momentum. Usually, those that are being stopped out as shorts can drive a much steeper and sharper liquidity squeeze than just a crawl higher like we've been seeing. It will be far more interesting to see if these charts are turning up, whether it actually creates a little bit of FOMO in the hedge funds, which is that they're underweight the equity and seeing the market moving, whether it actually puts money to work on the short term term that drives that move a little bit higher. I still don't see the underpinning conditions in my mind that would make a legitimate new bull market start. But I think that the market pausing here is obviously the reality of the current situation. Another thing that's a tailwind to that, if we go on page 3, is just looking at the volatility index. And as volatility of the markets narrows, it actually fuels some dealer buying as they can unwind a lot of their hedges. And so the fact that the VIX legitimately broke below 25 at this level is actually a short-term tailwind. One of the things that we'll be seeing is, if we see volatility normalizing back down to 20 or into the high teens where we saw over the last year some of the lows established themselves, that could be a short-term tailwind to the sales of the market and could continue to contribute to the market crawling higher. While I still think that the bear market legitimately may not be over and another full leg lower may be coming later in the year, we have midterm elections coming and everything is quiet here. It would be really interesting to see whether that summer doldrum theme that we were talking about just has a market grinding in a range and simply lacking any real meaningful conviction. And that really does seem to be what the current market price action is suggesting.
As we move on to page 4, I find it very interesting to compare the Euro USD chart to the dollar index chart. Because if I look at the dollar index chart, to my eye at least, it looks like a healthy consolidation. Looks like the 106 support is holding pretty nicely. I'm not too worried about it dumping lower. But boy, if I look at Euro US dollar, this chart doesn't look pretty to me.
Well, of course, it's the inverse, right? And I think the noteworthy thing is that one of the things that I think would be actually a genuine tailwind to risk assets would be if the euro was rallying and the U.S. dollar was going through a more meaningful or deeper correction. And really, there is no sign of that. I mean, the euro was so oversold when it hit parity, and it had every reason to meaningfully bounce even as high as 103, 104 on the upside. And after just a 2-3 day little slingshot reaction to 102, the euro is just stuck and it just feels heavy. And I wonder whether some catalyst can really emerge to change this trend. And I think that this actually is not working in the favor of risk assets. If we see that the euro rolls over and starts to sell, that would be a stress point. The one thing I don't have a chart of here where the pushback on that is what the price action we're seeing in that US dollar yen, because the US dollar really has more meaningfully begun mean reverting that huge bull run that it had against the yen over the last half year. And so we're really starting to see that we're going from a period where almost all cross currencies were perfectly correlated and the US dollar up was the dominant one. We're now starting to see a lot of mixed messages from the different currency crosses, which is actually making it a bit of a messy kind of call to make here. It'll be really interesting, though, to see whether the euro continues to behave like this. And even if it does have a quick little pop to 103, whether it quickly rejects and comes right back down. Right now, there is no sign of a pulse for the euro bulls.
Now, you said earlier that we weren't really seeing brisk price action on the S&P. Well, if you want to see brisk price action, take a look at that gold chart on page 5.
Oh, yeah. That's what a move. Now, I always want to say one thing. I always say to my members, which is one day doesn't make a new trend. I'm reluctant to already dynamically change my views just because of one up day. We're going to really want to see whether or not this draws new money flow and whether there's follow through and other things like that occurring. But we had an incredibly oversold gold market, and like we called on the show, it was testing an incredibly important support. It was a multi-year low along that 1680 to 1700 zone, and you had a bullish engulfing candle come in there right off of that low, and now with this reversal, it's at least putting in now a short-term bottom, but it'll be much more interesting, like Adam was suggesting earlier, which is it going to lead to more of an intermediate intermediate to longer term bottom, often that will involve the market retesting its previous lows or doing some sort of a basing formation. And so it'll be really interesting to see whether gold bases here throughout the summer and then subsequently sets up for maybe a fourth quarter change in trend and a bull run. I think it's going to, like I said, one day doesn't make a new trend, but certainly the short-term selling pressure has really subsided, and it really seems like gold is now going to give it a shot on the upside. We'll see whether it can beat those moving averages.
Well, Patrick, I'm going to give you first dibs on talking to the crude oil chart, because once you let me talk, it could be a while.
No problem. Well, isn't it interesting, though, Eric, that crude oil market is pinned right between the 200-day and the 50-day moving averages, 200-day being down at the $90 level and the 50-day being up at the $100 level. And I think you don't have to make it more confusing than simply waiting for crude oil market to commit on a breakout. I don't really envision any sustained sell-off below 90. I think even if we had a short-term liquidity washout that pokes down to $85, it would probably be almost immediately bought up and taken right back up, almost like the nat gas market did. But I think watching to see when the breakout happens out of this range will really define when a potential new trend move may be committing. And I think at this moment, considering a trade range bound or watching those support resistance levels is a easy way to technically observe when the next trend commits. What's your take on all of it?
Patrick, with respect to the chart and where the price action is headed from here, I basically agree with you. I use several moving averages on my charts, both the contract and continuation chart levels. Right now, the 200-day moving average on the continuation chart is at 94.27, and that's the level that's pretty much been holding. It's been tested quite a few times. As you mentioned, the 200-day contract moving average is actually down just below 90. It's actually 88.27. I was previously thinking that we were going to get down and test that, but we've had several tests of the continuation 200. One was a deep plunge below it. The next one was just a little plunge below it, and then last night we had one that kind of got close to it but didn't even come down to it. So we've got a new upsloping trend line, which looks like it's set to hold us above the 200, even the continuation 200 at 94.27 right now. And moving above that, I actually see the 100-day moving average on the contract chart, which is at 100.92 as the bull signal. If we get above that, it would take us also above last week's high, so we would have a pattern of higher highs and higher lows. It would also take us above a key moving average, and we're already trading above a longer-term downsloping trend line that's been in place since the sell-off began in June. It's not drawn on this chart, but you can kind of visually see it there. If you draw a line from the peaks in early June along where the price action is, you can see that we've just moved to the right of that line in the last couple of days here.
Eric, let's jump to, in the market wrap, you were talking about the SPR time spreads. What's up with that?
Okay, well, what was announced by the White House this week is they're going to be smarter, supposedly, about how they do these SPR releases. And the sales pitch is that by buying long-dated futures or forwards, the government can help the market now by pushing the front of the curve lower, and they can also help by providing producers with an easy way to lock in prices to replenish the SPR later. So essentially what's being proposed by the White House, if you translate it to trading terminology, is that the government would sell, let's say, a 6-month prompt time spread. So you're selling the front month contract, you're buying 6 months down the curve or a year down the curve, whatever it is that they want to do. That would result in a profit for the government. It's 6-month time spread until very recently was much higher. Even now it's upwards of $10 a barrel that they would make as a profit as a result of doing that. And if they were really serious about this, what they would say is, okay, so from now on, we're not going to just release any oil out of the SPR willy-nilly. When we do that, the way we're going to do it is sell the front month futures contract or sell a forward, the equivalent of the same thing, so that we're going to deliver oil out of the SPR against that front contract. But at the very same time, we're going to enter a contract, whether it's buying a futures contract or entering a forward contract, to buy later dated crude at a lower price. So we're guaranteed that the taxpayer is going to pay a lower price to replenish the oil that needs to go back into the SPR when the time comes to do that. I'm guessing that some smart person in the government came up with that idea and proposed it to the White House. And they said, yeah, that sounds good. We can spin that as if we were actually doing it. But the part about actually buying those longer dated futures or longer dated forwards now, we'll put that off. We'll do it later. Trust us. So in the next fiscal year, then we're going to buy those long-dated contracts and we're going to do all this stuff. You can trust us. I don't believe any part of this. It doesn't pass the smell test. They're not really doing a time spread trade. They're describing how a time spread trade would work, even though they're not really doing it. And it would be, frankly, any SPR release at a time of geopolitical tension like this is reckless and irresponsible. It's not what the SPR is for. But if you were going to do an SPR release, doing it the way they are kind of alluding to would make a lot of sense if they were actually doing that. It's the fine print about after the 2023 fiscal year begins is when they would actually do the other side of it. So they're going to do one side of that time spread trade and hope to leg into it after the 2023 fiscal year begins. I think that's November 1st, if we're talking about a federal government fiscal year. They're going to hopefully leg in and get a lower price, and they're not going to get whipsawed as the market maybe moves higher from there and they end up paying a higher price to replenish. I don't believe any part of this story, Patrick.
Eric, there was also some big news on the Nord Stream pipeline. What's the news there?
Of course, Nord Stream 1 is the pipeline that supplies Europe with natural gas from Russia. It was shut down for maintenance. They turned it back on last week, and now this week they've throttled it back intentionally to just 20% of its rated capacity. The explanation that was given is that there was another unspecified issue with a second turbine that is needed to pressurize the pipeline, and that's the reason. It's just technical difficulties. Don't worry, we're working on it. It sounds to me, frankly, like Putin is intentionally trying to show his teeth. He doesn't want to completely shut the gas off to Europe because that potentially starts a big geopolitical escalation. He only wants a little one right now. So he's showing them that he can turn the screws up or down at will, and for now it's throttled back to 20%. I'm guessing that Putin wants to put some pressure on Europe and make them feel some pain for a few weeks. And then I would guess that this supposed turbine problem will miraculously cure itself and he'll turn the gas back up, but probably not enough to allow them to replenish their underground reserves, only enough to keep them going so that we don't get a major escalation for now. I think he's getting ready to really put the pressure on come fall heating season. Now, what's a mystery to me, Patrick, is everybody is talking about the fact that Vladimir Putin is obviously withholding natural gas from Europe as a tool of economic pressure, or even economic warfare, if you want to call it that. So why it is that nobody seems to think that Putin would consider taking Russian oil off the market as an act of economic warfare is a complete mystery to me. It seems obvious that if he's willing to turn the gas off, he'd probably be willing to turn the oil off. It's not time to do that yet. It doesn't make sense strategically, but at some point I think it will, and that's the reason I feel so passionately that we should not be draining our SPR at such a critical time. It will be drawn down to only 53% of its capacity from more than 80% at the beginning of 2022 because of the White House's policy decisions, which I think have been incredibly irresponsible. And, just imagine what Putin could do to squeeze the West if he wanted to, how much risk we're creating. And I'm not saying that he has an agenda to do any of this. I'm just saying our policy decisions are creating immense vulnerability. If Putin wanted to, he could just give Europe as much gas as they need to keep them going until fall, but not enough to replenish their reserves. Then he could suddenly cut the gas to Europe and withhold half of Russian exports of oil. That would cause prices to spike instantaneously. It's entirely possible that it wouldn't even cost him anything in terms of revenue, because if the price doubles and the amount of exports gets cut in half, it's revenue neutral for Russia. And you think, well, wait a minute, we've still got plenty of capacity in North America. Yeah, we do, but remember, all of this shale oil that's produced in the United States cannot be refined in U.S. refineries until you blend it down with heavier oil. You got to have medium to heavy blend stock in order for U.S. shale oil to even be refinable, to be able to use it. Well, but we've got so much of it coming from Canada through the Keystone Pipeline. Okay, so what's to stop Russia if they were really trying to escalate a war situation or an economic war situation from sabotaging the Keystone Pipeline? And I'm not suggesting that they're going to hit it with a missile attack or do anything like that that would escalate a massive geopolitical tension. All they would have to do is insert FSB spies into the green movement and convince a bunch of environmental activists that the way to deal with big oil, which is evil, is we've got to bomb the pipeline and get a bunch of Americans who think they're doing the right thing because they're passionately committed to a unfortunately misguided environmental agenda so excited that they go and bomb the Keystone Pipeline. I mean, there's so many ways that we are vulnerable, and to be draining the Strategic Petroleum Reserve at a time like this, I think, is crazy.
Well, Eric, let's move on to just kind of taking a long-term view of the oil market, of what's happening here in the big picture.
Patrick, as I alluded to in the market wrap, I am convinced that we are in the very early stages of a global energy crisis that will be bigger than the 1970s oil shock. The world, and I'll make a very profound prediction now, I say the world will not return to the pre-pandemic normal economy because it can't. Why can't it? Because there simply isn't enough energy supply to meet pre-pandemic energy demand levels. Nor is there any credible plan to get back there. We did so much damage to the energy industry because of the pandemic and the negative prices and everything that happened. And policy is so focused in the opposite direction, making desperately needed capital expenditure investments almost uninvestable. So there is no possible way, I contend, to get back to normal for at least 5 years. And that 5-year clock, for how long it would take to get back to normal, doesn't even start until you see a policy reversal and we start making the right choices and we start encouraging rather than discouraging new investment in both energy exploration and production and also in new refining capacity, because we have as much of a refining capacity crisis as we have a crude oil supply crisis. Now, the recession that's coming will hide this reality from most people for a while longer. It's entirely possible that oil prices go down from here, although it looks to me like maybe they're bottoming. But, I could be wrong. And oil prices might very well go down another $10 or $20. But my point is the only way that can happen is because of recession-induced demand destruction. We can't recover back to pre-recession or pre-pandemic normal economic condition because skyrocketing energy costs will cripple the economy and hold us in recession. So we could have an energy-led stagflation. Now, all of that was true before the February 24th Ukraine event, and fixing it would require a total change of policy and attitude and at least 5 years of aggressive investment in both E&P and downstream refining capacity. Now, if you add to that the Russia-Putin angle, which is new, it's not the cause of this problem, but it definitely exacerbates it. I think Putin is smart enough to have a very strong understanding of this. He knows that the West is very vulnerable to having energy withheld from it, and he has the power now to engage in economic warfare centered on withholding access to energy. And everything he's doing, from inviting Saudi Arabia to join the BRICS alliance, the new global reserve currency that was just announced at the BRICS summit, Sergei Glazyev's new architecture for a central bank digital currency, which I predicted 4 years ago in my book, all of this is strategically in support of Russia trying to put itself in a place to control as much of the world's energy resources as possible and be able to withhold them from the West. We got into this, Patrick, from failed energy policy, and there's nothing that can correct it but a total change of energy policy and at least 5 years for that new policy to take effect, and it's going to be a really ugly ride.
Eric, I have to agree with so many of the points you're making, but when we go back to that interview that we had with Adam, he was really highlighting the natural gas situation as well. And boy, did that kind of catch me off guard. I never really considered a lot of the points he was making. And what I thought was really interesting was to just pull up a chart on nat gas, because what an extraordinary 2 months it's been this summer. First of all, nat gas made it up almost to $10 BTU, and suddenly went through an extraordinary sell-off that literally within a month had it lose close to 50% of its value. And it was when you see those kind of corrections, it often leads to a sustained sell cycle of some sort, as that's a pretty hefty correction. But just as fast as that sell-off occurred, even in a faster period of time, natural gas prices recovered all the way back to their highs, almost doubling off of that low point in just like 3 weeks. Incredible volatility that we're seeing. It's unbelievable, that thing. And the real question in my mind after listening to Adam's interview is like, is there really the potential here now for even another leg higher in this? And one of the things, I didn't put on any moving averages on here, but one of the things I'm going to be watching is this little pullback over the last couple of days. Will the bulls buy the dip? Will we see that the price action continues to challenge those highs? And is it setting up for something that I think would surprise so many investors, would be a natural gas breakout above $10 on a sustained basis? What's your thinking on that?
Well, it's very important, Patrick, to understand. Look at the pattern going back to the beginning of 2022. It's up, it's accelerating up, it's up, it's up, it's up. What happened that caused that sudden blow off top and the very sharp correction to the downside? It was the fire at the export terminal that Adam discussed in today's feature interview. Now, the thesis behind Adam's very bullish view that he expressed back in May in the letter that is linked in your Research Roundup email, that thesis was based on the idea that there's going to be a convergence between U.S. and European natural gas prices because we're getting more and more export capacity and therefore arbitraging those two markets by exporting U.S. natural gas and sending it to Europe becomes far more practical and possible than it ever was before. That was driving the rally exactly at the point where one of the major export terminals took 20% of U.S. natural gas export capacity, liquefied natural gas export capacity, got taken off the market suddenly with that fire. You see prices crash because all of a sudden the basis for Adam's thesis stops being there. We get all the way down to the beginning of July. And what I find most interesting about this chart, Patrick, is the sell-off starting in the beginning of June also coincides with the sell-off in crude oil prices, which most people attribute to the market pricing in the coming recession. But hang on a second. The crude oil kept on selling off on a very steady, consistent downtrend right through last week, and maybe it's still going to continue. We're right on some key support levels just as we're speaking right now. It's just about the pit close on Thursday, and we're touching on the 13 and 5-day moving averages. Not clear whether we'll hold them into the close. But Patrick, the nat gas recovered beautifully from the beginning of July. What happened in the beginning of July? They didn't fix the Freeport export terminal, which took 20% of capacity off. What did happen in the beginning of July is we saw Europe being pressured around the Nord Stream pipeline. Now, wait a minute. We used to think of the U.S. and European gas markets as being totally disconnected because you can't arbitrage between the two of them because it's too hard to transport natural gas. But it is approximately coincident with the turbine situation and people getting afraid of what could happen, the doomsday scenario about Nord Stream 1. That was all a Europe story. But look at how the recovery in U.S., because this chart is Henry Hub U.S. natural gas futures. It recovered when the pressure was put on Europe, and it was a short-term tactical pressure put on Europe. So it seems pretty clear to me that transmission mechanism Adam is talking about is real. And I would think, I haven't asked Adam about this, I should have asked him in the feature interview, it's not really an expectation that U.S. nat gas prices are going to parity with European prices, but rather the cost of export and transport plus U.S. gas price ought to reach parity with Europe. So the question there is, how much of a discount is there because of the cost of that arbitrage to deliver the gas? It's much more significant than it is for crude oil. But still, there's plenty of room with nat gas prices in Europe already $30 plus and set to go higher if they get squeezed. It could double or triple from here. There's plenty of room, I think, for Adam to be proven right and U.S. gas prices to move much, much higher. The big question in my mind is when that happens, when U.S. nat gas prices, let's say they do move sustainably above $10, well, what does that do in terms of changing behavior? All the people that are flaring off nat gas in the U.S., I suspect would suddenly be motivated to build a pipeline. Of course, maybe they would be stopped from building that pipeline by environmental activists. I don't know. It's going to be very interesting to see how this plays out.
Moving on to page 8, let's talk about some of the other forms of energy. What's interesting, first of all, is that coal prices have been generally holding up, and now we move to this chart here on uranium, and it's kind of like all intertwined. Energy is energy, just comes in different forms, and the question is that if we have increasing shortages developing in the traditional energy markets, does that translate to regaining new bull markets in all of the periphery ones, such as uranium? And what's interesting is that we had a pretty solid breakout on the Sprott Physical Uranium Trust out of a almost 2-month trade range, and it's just attempting to break above all of its moving averages and to start to turn up. And again, a similar thing to what I said in gold, one day doesn't make a new trend, and I don't want to already say that this is for certain underway, but wouldn't it be interesting to see if the bull market resumed here in uranium as well?
Well, Patrick, I certainly think that the world needs a nuclear renaissance. Specifically, we should get rid of the old technology, boiling water, Westinghouse reactors, and build these things in factories so that they are to much higher quality standards with much higher fault tolerance, and really, really invest in electrifying the global economy using a combination of nuclear and geothermal power. But, nobody listens to me, and I can't help but think, wait a minute, the trend, regardless of whether I agree with it, is really toward decommissioning nuclear power plants. And I think that Germany made a horrific mistake decommissioning 3 of their nuclear power plants so they can restart coal-fired electrical generation plants, supposedly in the name of the environment. I think it's very, very misguided policy. But it does seem to be the policy trend. So I guess I don't see how you get a real structural bull market in uranium until there is a change of policy. Now, maybe the market is starting to sniff out the need for that policy change and is expecting it to come soon. I sure hope so, but boy, I don't see in the political headlines any signs of it.
So moving on to page 9, I have that chart of wheat futures on the continuous, and I know Adam was referencing, and we should get his partner on to talk a little bit more about the ag markets. But obviously, we had a huge pop back in March in the upside of wheat futures, and it's pretty interesting to see that we've given almost all of it back. I mean, it's wheat prices, from peak down to trough have just obviously rounding, but have lost almost half of their value, and it's going to be really interesting to see whether this is actually where a key support line starts to establish itself, and whether, like many of the other commodities that have started to turn up, whether wheat is sold enough, and whether or not we're going to have some sort of a quick little bull reaction, at minimum, to retest its moving averages, which would be a return back to the 920 level above. It'll be interesting to see whether that starts to materialize here.
I agree, Patrick, and this trend in grains has been going on for years. It's really not just a result of the Russia conflict, but obviously you can see February 24th began a panic buy cycle. A lot of wheat exports come from Russia and Ukraine, and with the conflict going on there, everybody panicked. We got that blow off top. We've come back down to the pre-February 24th level. I think that might be the logical point for the resumption of a bull move from here. But then again, on the technical side of this chart, boy, it sure looks like we've got a death cross coming up on your moving averages here, or about to happen. It hasn't quite happened yet. So it'll be really interesting to see which way this market goes from here.
Eric, I just wanted to wrap up our little chat on the charts with just putting up the 10-year yield that we just discussed in the market wrap. And I really just wanted to make the quick observation of just how significant this little breakdown has been in yields, which is, I mean, the last time we saw yields like this was all the way back in April. I mean, we've seen a sustained push. We've seen extraordinary CPI print. And yet yields have really started to decisively roll over and potentially begin some sort of I don't want to say a new downtrend, but at least a deep mean reversion of the prior rise. And the question here is the bond market sniffing out the economic slowdown and that we're moving down that direction. It's going to be really interesting to see how far these yields pull back during the cycle.
And the other aspect of this, Patrick, is that interpreting a chart like this becomes a little more challenging because with a recession imminent, you have to ask yourself, okay, is this chart telling us that the market is sniffing out that inflation's not really a big threat, it's peaked, it's over with, that's what the signal is? Or is it that inflation still is a problem, but the market is still smelling out economic weakness coming, and going into a recession, you typically get declining yields? Or is it some combination of those two things? It's really hard when you have multiple signals overlaid in the same price series to figure out what the driver is. And of course, that leads to lots of difference of opinion. But listeners, if you enjoy these charts and chart decks that Patrick puts together, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. You can find the information on slides 11 and 12 of the slide deck, or just go to bigpicturetrading.com. We're going to leave it there for this week's show. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to the chart book we just discussed in our post-game, as well as a number of links to articles that we found really interesting. So you're going to find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. For those of our listeners that write or blog about the markets who would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow me on Twitter @Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.